Silver is down 45% from its all-time high. The SLV ETF has shed over $3.6 billion in assets. The chart looks like what one analyst this week described as a crime scene, and the question that every single silver investor is asking right now is the one nobody wants to say out loud: is it about to crash? Even harder? That question is going to be answered completely and honestly in the next 12 minutes. No false hope, no unnecessary fear, just the data. Stay with me because this one is important. Here are the exact numbers as of March 21, 2026. Spot silver is trading at approximately $67.95 per ounce. That is a 45% decline from the all-time high of $121.62 reached on January 29th. Silver has entered what analysts are formally classifying as a technical bear market, defined as a decline of 20% or more from a recent peak. The SLV ETF has shed over $3.6 billion in assets since the start of 2026 for consecutive losing sessions, nearly 20% in a single week. These are not small numbers. This is a historic two-week period in the precious metals market. Now here is the question you came here for. Is it going to crash even harder from here? The honest answer requires looking at both sides without flinching. So let us start with the case that yes, silver could fall further, because it is a serious case and you deserve to hear it clearly. The most direct downside case comes from JP Morgan. Their analyst issued a stark warning that silver could crash back to $50 if speculative positioning fully unwinds, not 50% from the high, $50 absolute. From today's $68 price, that would be another 26% lower. Technical analysis published this week identifies specific downside targets. The first is $65, which analysts suggest could be tested if the dollar index continues to strengthen. Below that, the next significant level is $62.26, which is the 200-day moving average. Below that, the extreme downside case. Targets below $55 representing a potential 25% further decline from current levels. Here is the structural reason those downside targets are possible rather than just theoretical. The Bank for International Settlements published their March 2026 quarterly review this week. They characterized January's silver spike from $30 to $121 as a classic speculative overshoot, driven by momentum rather than a genuine repricing of fundamental value. What the BIS is telling the financial world is that the move was not organic. It was speculative, and speculative moves have a natural tendency to fully retrace. If the BIS analysis is right that the January move was speculative excess, the downside risk is not just $265. It could be significantly larger. The SLV ETF outflow data confirms the institutional selling is still ongoing. $3.6 billion leaving silver ETFs is not retail panic. That is institutional money rotating out of silver into other assets. Analysis published this week noted that the Iran war, rather than supporting silver as a safe haven as most investors expected, has actually pushed investors to rotate into Bitcoin and Ethereum instead. When the assets that are supposed to go up during a crisis go down while crypto goes up, it tells you that the investor base supporting silver has fundamentally changed its behavior, and changed institutional behavior does not reverse quickly. JP Morgan's metals team said something that every silver investor needs to hear this week. They said the bank remains more cautious on re-engaging in silver in the near term until it becomes clearer that the recent froth in prices has been fully shaken out. JP Morgan, the largest bank in the United States, is not buying this dip. They are watching and waiting. And when institutions of that size are watching and waiting rather than accumulating, the price tends to drift lower until the sellers are fully exhausted. The CME margin situation is also still in play. In December 2025, CME Group raised initial margin requirements on silver futures contracts to $25,000 per contract that forced smaller traders without sufficient capital to close positions or face automatic liquidation. Margin requirements can be raised again if volatility persists. Each additional margin hike creates a new wave of forced liquidations from investors who cannot meet the higher requirements. It is a mechanism that can amplify selling far beyond what the fundamental picture would justify. So that is the honest bearish case. Silver at $68 could go to $65. It could go to $62. In the worst institutional scenario, it could go to $55 or below. These are published technical targets and institutional forecasts from credible sources. Anyone who tells you the bottom is definitely in at $68 is guessing. Nobody knows exactly where the floor is. Now let us talk about the case that the crash is nearly over, because despite everything just described, there is a genuinely compelling case that silver is approaching a tradable bottom, and it is built on data, not hope. CoinCodex updated their algorithmic price model on March 20th. Their system analyzes silver's historical price patterns and current technical setup and is projecting that silver will increase for 0.97% in the next 7 days to reach $71.23 by March 26th. The same model projects silver reaching $91.66 by year-end 2026. That would be a 35% increase from today's crash price, not the all-time high from today. Technical analysis published this week made one specific observation that cuts through all the noise. Price has stabilized above $74, a level that previously acted as resistance during the early breakout. That flip from resistance to support is the one thing bulls can point to when a level that was previously hard To break through becomes a floor. It signals that genuine buying interest exists at that price. Real buyers, not algorithms reacting to momentum. Buyers who looked at the chart and decided that $74 is where they want to establish positions. The gold to silver ratio right now is sitting at 64.6. That is historically extreme. When this ratio has been this wide in the past, it has almost always closed by silver outperforming gold in the subsequent period, not by gold falling, by silver recovering faster. The mathematical reality is that silver at $68 with gold at $4,495 is priced at a level that every historical precedent says is too cheap relative to gold. The question is not whether silver is cheap at these levels. Every serious analyst who looked at the ratio agrees it is cheap. The question is timing. How long does it stay cheap before the ratio normalizes? Silver moves approximately 1.7 times faster than gold in either direction. That amplification works both ways. Silver fell harder than gold during this crash. It will recover faster than gold when the recovery begins. The investors who are positioned in silver when the recovery starts will capture a larger percentage gain than those positioned in gold. The timing is uncertain. The amplification dynamic is not. The physical demand picture is also telling a story that the paper price is currently ignoring. Despite the paper price crash, physical silver premiums, meaning the extra amount real buyers pay above the spot price for actual coins and bars, have not collapsed to the same degree as the futures price. Dealers who buy and sell real metal are not dropping their prices by the full amount of the paper market sell-off. That tells you that the buyers of physical silver, the people who accumulate actual ounces rather than paper contracts, are not panicking. They are waiting. And when they step in aggressively, which historically happens when paper prices fall far enough below physical reality, the physical demand creates a floor that the paper market eventually has to respect. The industrial demand angle also remains intact despite the paper price crash. Silver is still consumed in enormous quantities by solar panel manufacturers, electric vehicle producers, AI data centers, and semiconductor fabricators. These industrial buyers do not have the option to simply stop buying silver because the price went up and then came back down. They have purchase orders, they have production schedules, they have contracts that require silver regardless of what COMEX says on any given Friday, and as the world continues building renewable energy infrastructure, electric vehicles, and artificial intelligence hardware at record pace, the industrial demand floor under silver gets larger and more permanent every quarter. Before going to the final section, hit the like button right now and subscribe if this analysis is giving you the real picture you need. Turn on the notification bell so you never miss an update during a fast-moving situation like this one. It is completely free and it makes a real difference when markets are moving this quickly. Here is the balanced, honest answer to whether silver is about to crash even harder. In the short term, the risks are real. The bearish case $265, $62, or even $55 is supported by credible technical analysis, JP Morgan's caution, and the ongoing dollar strength from the hawkish Federal Reserve. Anyone who adds silver right now needs to be prepared for the possibility that they are early, that the bottom is not at $68, that further pain is possible before the recovery begins. In the medium term, the case for a significant recovery from current levels is equally supported by credible data. The Coindex model says plus 5% in 7 days. The gold to silver ratio at 64.6 is historically unsustainable. The physical premium data shows real buyers are not panicking. The industrial demand is permanent and growing, and every credible institutional year-end forecast, from JP Morgan's $81 average to UBS's $85 target to Bank of America's $135 base case, sits above today's price, in some cases dramatically above it. The difference between a crash getting harder and a bottom forming is determined by 3 specific data points in the coming week. First, whether silver can hold above $65 on a daily closing basis when markets reopen on Monday, March 23rd. A sustained close below 65 would suggest the next level down is the next test. A bounce from 65 or above on Monday would suggest the sellers are running out of steam. Second, whether the dollar index begins to stabilize or pull back from the 100 level. The dollar's direction is the single most powerful short-term driver of silver's price. If the dollar stalls, silver gets breathing room. Third, whether any of the upcoming US economic data releases next week, including manufacturing PMI, jobless claims, and housing data, come in weaker than expected. Weak economic data gives the Federal Reserve cover to soften its language around rate policy, and any hint of Fed softening reverses the dollar's strength almost immediately. The silver crash of 2026 is real. The 45% decline from the all-time high is real. The $3.6 billion in ETF outflows are real. The JP Morgan warning about $50 silver is real, and the possibility that the selling is not yet complete is real. But equally real is the historical pattern of extraordinary recovery that follows every major silver crash, the industrial demand that does not disappear because paper traders had a bad week, the gold to silver ratio that says silver is historically cheap relative to gold right now, and the institutional forecasts that cluster between $81 and $309 by year-end from the same institutions that are being honest about the near-term risks. This is what the complete picture looks like. Not just the crash, not just the recovery potential. Both, simultaneously, right now. Before closing out today, one question needs your answer in the comments below. Do you think silver finds its floor above $65 and starts recovering next week? Or do you think this selling has further to run towards 62 or below? Drop your prediction and your reasoning. The best predictions in the comments consistently come from investors who have done their homework, and your answer will directly shape what gets covered in the Monday market open update. Share this video with one silver investor who needs the complete honest picture right now rather than just the scary headlines or the false reassurance. The crash is real, but so is what comes after it. See you in the next one.